What if the safest place you were taught to keep your money was actually a guaranteed way to lose it? We're told to save for a rainy day, to build a nest egg. But the very tool we use to do this, the humble savings account, has a hidden mechanism inside. A mechanism that ensures the value of your hard-earned money slowly, silently evaporates over time. This isn't a conspiracy, it's just how the system is designed. From our first piggy bank, the lesson is simple. Save your money. Put it in a bank. It's the responsible thing to do. Banks are pillars of our communities, their vaults synonymous with security. A savings account feels like the financial bedrock of a stable life. It's where you put your emergency fund, your down payment for a house, your future. It's insured by the government, it's liquid, it's safe. This is the story we are all sold. And on the surface, it's not wrong. Your dollars are safe. If you deposit $1,000, you can withdraw $1,000, plus a little bit of interest. The number on your screen will go up. But what the number on the screen doesn't tell you is what that money can actually buy. The story of safety is a carefully constructed illusion, distracting you from a much more important truth: the slow, relentless decay of your purchasing power. Meet the silent thief that operates in plain sight: inflation. We hear the term on the news, but we've been conditioned to think of it as a complex economic abstraction. It's not. It's the systematic debasement of currency. Think of it this way. What matters isn't how many dollars you have, but what those dollars can buy. If a cup of coffee cost $2 last year and costs $2.10 this year, your dollar has lost purchasing power. That's inflation in action. Now let's look at the numbers. For decades, the interest rate paid on the average savings account has been consistently, and often dramatically, lower than the official rate of inflation. Let's say your savings account pays 1% APY. But if inflation is running at 3%, you haven't gained 1%, you've lost 2% of your purchasing power. Your money is on a treadmill, running backward. This isn't an accident, it's a feature of modern central banking. Governments and central banks need a little inflation to encourage spending and investment, and to manage massive debt loads. But for the saver, it functions as a hidden, undeclared tax on your cash. You are being punished for being responsible.
So if your savings account is a losing game, why do banks want your money so badly? Because you are not their customer, you are their product. Or more accurately, you are their cheapest source of capital. Here's how it works. When you deposit $10,000, the bank doesn't put it in a vault with your name on it. Under a system called fractional-reserve banking, they are required to keep only a small fraction of that deposit on hand. The rest, let's say $9,000, they immediately loan out. They loan it to someone else for a mortgage at 7%, a car loan at 8%, or credit card debt at 22%. They are making a significant return on your money, while paying you a tiny fraction of a percent for the privilege. The difference between the interest they earn and the interest they pay you is their profit. It's called the net interest margin. You are taking on 100% of the inflation risk, while the bank reaps the rewards of leverage. They have privatized the gains from your capital and socialized the risk, the loss of purchasing power, back onto you.
Understanding this system isn't about blaming banks. It's about changing your own strategy. It means recognizing that holding large amounts of cash over long periods is not a safe strategy. It is a guaranteed loss. Think of your cash savings like a melting ice cube. It's essential for short-term needs, but you wouldn't store your entire water supply as an ice cube on a warm day. This is why we must separate the concept of an emergency fund from long-term savings. An emergency fund of 3 to 6 months' worth of expenses needs to be liquid and accessible. Yes, it will lose some purchasing power in a savings account. Think of that loss as an insurance premium you pay for immediate access and stability. But any money beyond that, your long-term wealth, must be put to work. It needs to be in a vehicle that has the potential to grow faster than inflation. The goal is not just to save money. The goal is to preserve and grow your purchasing power. This requires a fundamental shift in mindset, from passive saver to an active preserver of your own capital. The biggest risk is not learning the rules of the game you're already playing.
So, to recap, the safety of a savings account is an illusion that hides the reality of declining purchasing power. Inflation acts as a silent tax on your cash, and banks use your deposits to generate massive profits for themselves. The solution isn't to stop saving, but to redefine it. Use savings accounts for short-term emergencies and find ways to make your long-term capital work for you, to outpace the silent theft of inflation. You've been taught to play defense with your money. It's time to learn the rules of offense. If this decoded a piece of the financial world for you, subscribe and press the bell icon. You won't just get an alert, you'll get a piece of the map. In our next episode, we'll decode the next logical step. If not a savings account, then where? We'll break down the world of investing for people who believe they hate risk. See you then.